Investment strategies are systematic approaches used to achieve specific financial objectives while managing risk and uncertainty. A well-designed investment strategy aligns with an investor's goals, time horizon, liquidity needs, tax situation, and risk tolerance. Financial planners develop investment strategies to provide a disciplined framework for decision-making and to reduce the influence of emotions during periods of market volatility. Effective strategies focus on long-term objectives rather than short-term market fluctuations and are built upon principles such as diversification, asset allocation, risk management, and periodic portfolio review. By following a structured investment approach, investors can improve consistency, maintain discipline, and increase the likelihood of achieving desired financial outcomes. One of the most important investment strategies is strategic asset allocation. This approach involves establishing a target mix of asset classes, such as stocks, bonds, cash equivalents, real estate, and alternative investments, based on an investor's financial profile. Strategic asset allocation emphasizes maintaining a long-term portfolio structure regardless of temporary market conditions. The allocation is designed to balance expected returns with acceptable levels of risk. Periodic rebalancing restores the portfolio to its target allocation when market movements cause asset weights to drift. Financial planners often view strategic asset allocation as a primary determinant of long-term portfolio performance because it establishes the portfolio's overall risk-return characteristics. Tactical asset allocation represents a more active investment strategy that allows temporary adjustments to asset class exposures based on market opportunities and economic expectations. Investors may increase or decrease allocations to particular sectors, industries, or asset classes when they believe certain investments are likely to outperform. Tactical strategies seek to enhance returns by responding to changing market conditions while still maintaining an underlying long-term asset allocation framework. Although tactical allocation may provide opportunities for additional gains, it also introduces the risk of incorrect market forecasts. Financial planners carefully evaluate whether tactical adjustments are appropriate given a client's objectives, investment expertise, and tolerance for additional uncertainty. Growth and income investing are two commonly used investment strategies designed to meet different financial objectives. Growth investing focuses on companies or assets expected to experience above-average earnings and revenue growth. Investors pursuing growth typically seek capital appreciation and may accept higher levels of volatility. Income investing emphasizes generating regular cash flow through dividends, interest payments, or distributions. Income-oriented portfolios often include bonds, dividend-paying stocks, real estate investments, and income-producing funds. Financial planners frequently combine growth and income strategies to balance current cash flow needs with long-term capital appreciation. The appropriate mix depends on factors such as age, financial goals, and retirement planning requirements. Value investing and passive investing represent additional important investment approaches. Value investing involves identifying securities that appear undervalued relative to their intrinsic worth based on fundamental analysis. Investors seek opportunities where market prices may not fully reflect underlying business value. Passive investing, by contrast, focuses on tracking the performance of market indexes rather than attempting to outperform them through security selection. Exchange-traded funds and index mutual funds are commonly used for passive strategies. Passive investing often offers lower costs, broad diversification, and reduced trading activity. Financial planners evaluate these approaches based on client preferences, market expectations, investment costs, and long-term wealth accumulation objectives. Alternative investments are asset classes that differ from traditional stocks, bonds, and cash equivalents. Common alternative investments include private equity, hedge funds, venture capital, real estate partnerships, commodities, collectibles, and certain structured products. These investments may offer diversification benefits because their returns are often influenced by factors different from those affecting traditional financial markets. Alternative investments can also provide opportunities for enhanced returns in certain market environments. However, they frequently involve higher complexity, increased fees, limited transparency, and greater risk. Financial planners carefully evaluate alternative investments to determine whether they are appropriate within a client's overall portfolio strategy and risk management framework. Liquidity risk is a significant consideration when investing in alternative assets. Liquidity risk refers to the possibility that an investment cannot be sold quickly at a fair market value without incurring substantial losses. Many alternative investments lack active secondary markets, making it difficult for investors to access funds when needed. Real estate, private equity, hedge funds, and certain partnership interests often involve lockup periods, withdrawal restrictions, or extended holding periods. Financial planners assess liquidity needs carefully because insufficient access to cash can create challenges during emergencies, market downturns, or unexpected financial obligations. Managing liquidity risk is essential to maintaining overall financial flexibility and stability. Investment strategies and alternative investments must be integrated thoughtfully within a comprehensive portfolio management framework. While alternative assets may provide diversification and return enhancement opportunities, they also introduce unique risks, including liquidity constraints, valuation challenges, and operational complexities. Financial planners evaluate these investments in the context of overall portfolio objectives, asset allocation targets, and client-specific circumstances. Effective investment strategies balance growth potential, income generation, risk management, and liquidity requirements. By combining disciplined portfolio construction with careful assessment of alternative investments and liquidity risks, investors can pursue long-term financial goals while maintaining the flexibility needed to respond to changing market conditions and personal financial needs.